In the next 18 months, we could witness one of the largest wealth transfers in modern history. Millions may lose what they've spent decades building. A small group will position themselves to build generational wealth. The difference? Four financial secrets that most people never discover until it's too late. Ray Dalio predicted the 2008 crash. He manages $124 billion and has studied every major economic collapse across 500 years. And right now, his research is pointing to patterns that look eerily familiar. We're approaching the later stages of a long-term debt cycle. U.S. total debt has reached $90 trillion. The government now spends over $1 trillion annually just on interest, surpassing defense spending for the first time in modern history. The window to prepare doesn't stay open forever. But if you understand these four secrets and begin applying them today, you can position yourself on the opportunity side of what's coming. Before we reveal exactly what they are, hit that subscribe button now. What you're about to learn could reshape how you think about protecting and building wealth. Now, let me tell you about a painful lesson from Dalio's own experience. In 1982, he publicly predicted a depression. He was certain. He was confident. He went on television, told his clients, and bet everything on being right. And he was completely wrong. The economy boomed. The market went up. His clients left. His reputation was shattered. He had to borrow $4,000 from his father just to pay his bills. He had a wife and 2 young children and didn't know how he was going to support them. That failure became the foundation of his success. It taught him to stop making predictions and start studying patterns, to look at what has actually happened in similar situations throughout history, instead of betting on what might happen next. And when you study wealth destruction patterns across every major economic shift, 4 secrets emerge. These aren't small tips. These are the principles that separate those who weather storms from those who get swept away. Let's examine the first secret. Here's what most people miss about wealth. The loudest signals around you are often the least reliable. Look at your neighbor with the new BMW. Look at your coworker with the designer watch. Look at the family on Instagram posting vacation photos from the Maldives. What you're seeing isn't wealth. What you're seeing is the performance of wealth, and there's a world of difference. Dalio's research across thousands of households reveals something striking. 78% of people who appear wealthy are actually operating on borrowed money and borrowed time. They're financing everything. The car is leased, the house is over-leveraged, the vacation was charged to a credit card that's still carrying a balance. They're not rich, they're performing a role. And here's the trap. When you see these signals, your brain naturally interprets them as evidence that you're falling behind, that you should spend more to keep pace, that you need to match their lifestyle, or you're somehow failing. This is the comparison trap, and it quietly destroys more wealth than dramatic market crashes. Let's look at the arithmetic of what this actually costs. Picture this. You buy a new car for $50,000 because that's what successful people drive. The moment you drive it off the lot, it's worth $40,000. You just watch $10,000 vanish in 10 minutes. By year 3, that car is worth $25,000. Half your capital gone. But here's what really compounds the damage. Most people finance these purchases. They take out loans at 6 or 7% interest to buy something that's losing value at 15 to 20% annually. This creates underwater debt where you owe more than the asset is worth. Think about this differently. That $50,000 you spend on a new car, if invested at 10% for 20 years, grows to $336,000. You're not just buying a car, you're trading $250,000 in future wealth for a few years of looking successful. Warren Buffett, worth over $100 billion, drives a modest car and lives in the same house he bought in 1958 for $31,500. Why? Because he understands something fundamental. Every dollar spent on appearing successful is a dollar that can't compound into actually becoming successful. Here's what the data reveals. In every major economic shift, the people who thrive are the ones who ignored the performance of wealth. They drove used cars while their neighbors drove new ones. They lived in modest homes while their colleagues over-leveraged. They looked ordinary while everyone else looked flashy. And when the shift came, look what happened. Their neighbors faced foreclosure. Their colleagues lost everything. The flashy people became the struggling people, but the ordinary ones had capital. They bought assets at steep discounts, and within a few years, they had built serious wealth. The first secret is simple: never trust what you see. Most of it is theater designed to make you spend money you haven't earned on things you don't need. This is the secret that protects you from everyone else's problems becoming your problems. Here's the pattern. The moment people know you have money, something shifts. You stop being a friend and start being a resource. Look at what Dalio's research on wealth preservation shows. The single fastest way to lose accumulated capital is to let people know you have it. Because once they know, the requests begin. Can you loan me money for a car repair? Can you invest in my business idea? Can you help with my medical bills? Every request sounds reasonable. Every person feels entitled to your help. And if you say no, suddenly you're the villain in their story. This is what researchers call the audit trap. Once people know your number, they start auditing every dollar you spend. If you decline to buy the expensive wine at dinner, they don't think you're being prudent, they think you're being cheap. They say, "Come on, you can afford it." They believe that because you have more, you have an obligation to fix their shortfalls. But here's what they don't see. Wealth is fragile. It takes decades to build and moments to lose. Every dollar you give away is a dollar that can't compound. Every loan that doesn't get repaid is capital gone forever. The research on lottery winners tells this story over and over. A person wins $10 million. Within 6 months, every distant cousin shows up with a sad story. Every neighbor has a business idea that just needs a little capital. Every friend has an emergency that requires a loan. And because the winner struggles to say no without destroying relationships, they say yes and yes and yes until the money vanishes. And the people who took it, they're gone too. There's another layer to this. Price discrimination. When you walk into a negotiation, information is leverage. If a contractor comes to fix your roof and sees an old car in the driveway, he quotes you the fair market price. But if he knows you just sold your company for $10 million, somehow that roof repair costs 3 times more. He's not charging you for the labor. He's charging you for what he thinks you can afford. That's how wealth slowly bleeds away. Dalio himself practices what he calls strategic camouflage. Despite managing over $100 billion, he doesn't project the image of a walking bank. He keeps interactions honest by appearing ordinary, so people approach him as a person, not as an opportunity. Before we continue to Secret 3, pause this video for just a moment. Think about one person who knows more about your finances than they should. Starting today, practice strategic silence with them. Your financial future may depend on it. The second secret is silence. Your net worth is nobody's business. Your next investment is nobody's business. The only people who need to know are your spouse and your tax accountant. Everyone else represents a potential leak in your financial fortress. This is where many people sabotage themselves right before crossing into real wealth. Let's look at something fundamental. An asset puts money in your pocket every month. A liability takes money out of your pocket every month. Your house takes money out every month through mortgage payments, property taxes, insurance, maintenance, utilities, and repairs. It's a drain, and the bigger the house, the bigger the drain. But doesn't real estate always go up in value? Let's look at what actually happened in history. In 1989, Japanese real estate was the most valuable in the world. Tokyo land prices were so extreme that the Imperial Palace grounds were theoretically worth more than all the real estate in California. Everyone believed Japanese real estate could never fall. It was an island nation with limited land and a wealthy population. The logic seemed solid. Then look what happened. Real estate prices fell for 20 consecutive years. Peak to trough, residential real estate lost 60 to 70% of its value. Someone who bought a house in 1989 thinking it was the safest possible investment wouldn't break even until 2020. 30 years of zero returns while paying a mortgage, property taxes, and maintenance on a declining asset. The same pattern played out in America. People who bought in 2007 watched their home values collapse 40% by 2011. Here's the trap. People stretch themselves to buy the maximum house the bank will approve. The bank says you qualify for $500,000, so you buy a $500,000 house. This is where things go wrong. Look at the real numbers. A $500,000 house with a 30-year mortgage at 7%? You actually pay over $1.1 million when you include the interest. You're paying $600,000 extra just for the privilege of borrowing money. That's not building wealth. That's transferring wealth from your pocket to the bank's pocket for 3 decades. Dalio's research on debt cycles shows this pattern clearly. Debt is a tool that makes rich people richer and poor people poorer. When investors borrow money to buy productive assets that generate cash flow, that's strategic debt. When you borrow money to buy the biggest house you can possibly afford, that's dangerous debt. You're leveraging to acquire something that drains cash flow. Here's the alternative approach that the data supports. Buy half the house the bank says you can afford. If they approve you for $500,000, buy a $250,000 house. It doesn't matter if it's smaller or lacks granite countertops. Then take all that extra money you're saving every month and direct it into businesses with pricing power, dividend-paying stocks, and assets that actually put money in your pocket instead of taking it out. This becomes even more critical when you understand where we are in the economic cycle. We're likely 12 to 24 months away from significant pressure on over-leveraged assets. When that pressure arrives, housing markets in certain regions may face challenges. Position yourself to be a buyer when others are forced to sell, not the other way around. The third secret is this: never borrow money to buy things that drain your resources. Save that leverage for assets that feed your resources. That's how you build wealth that endures. This might be the most important secret because it's the one your financial advisor will likely never share. Here's what few people are telling you. The environment that made buy and hold work beautifully from 1980 to 2020 has fundamentally changed. We had 40 years of falling interest rates from 15% in 1981 to basically zero in 2020. That environment created one of the greatest bull markets in history. Every dip was a buying opportunity. Every crash recovered. The strategy worked consistently. But here's the challenge. You can only cut rates to zero once. We're now in a different regime, and the strategies that built wealth over the last 40 years may not work the same way over the next 10. Let me tell you about Jessica. She was a financial advisor at a major firm for 15 years. She put her clients in 60-40 portfolios, 60% stocks, 40% bonds. Standard advice, conventional wisdom. In 2008, her clients lost an average of 47%. But look at this. Jessica had her own money positioned differently in gold and cash. She understood the playbook. She just couldn't share it with her clients. Why? Because her firm generated fees from assets under management, and gold and cash generate zero fees. Jessica retired at 52. Her clients, many are still working. Dalio's research across 500 years of economic history shows this pattern. When major debt cycles reach their later stages, they create significant shifts, and different types of assets respond very differently. Look at what actually happened in previous cycles. In the 1930s, it wasn't just stocks that faced challenges. Government bonds faced defaults. Corporate bonds faced massive defaults. Stocks fell 89%, peak to trough. The people who preserved wealth were the ones who owned physical assets like gold, productive farmland, and businesses with pricing power. In the 1970s, the same pattern emerged. Bonds were eroded by inflation. The 10-year Treasury lost over 60% of its real value from 1970 to 1980. Stocks went essentially sideways for a decade. But when you adjust for inflation, which ran at 7 to 9% annually, real purchasing power for stock investors declined by over 50%. Someone who bought stocks in 1968 didn't break even in real terms until the early 1980s. 13 years of watching purchasing power evaporate while advisors said stay the course. But look at what happened to 4 types of assets. Gold went from $35 per ounce to $850, a 24-fold increase. Businesses with pricing power like energy companies saw revenues multiply 7-fold. Agricultural land doubled and tripled in value. The pattern tends to repeat every 75 to 100 years. When debt cycles reach their conclusion, paper assets often struggle. Physical assets often hold their value. Here's what often happens. Your financial advisor won't show you this historical data because if they did, you might ask uncomfortable questions like, why am I paying you to put me in strategies that struggle during similar periods? They don't have a compelling answer, so they don't show you the data. They show you charts going back 40 years demonstrating that stocks always recover eventually. They talk about diversification. They downplay historical concerns. But look at what Dalio's research actually reveals. Your 60/40 portfolio faces challenges we haven't seen in decades. That strategy was built for a falling interest rate environment. When rates fall, bond prices rise, and stock valuations expand. Both sides work in your favor, but we're not in that environment anymore. Rates hit zero in 2020. They rose to 5% in 2022. Even if they decline to 3 or 4%, we're likely not returning to zero. When rates rise or stay elevated, bonds face pressure. A 10-year Treasury bond can lose 10 to 15% of its value for every 1% rise in interest rates. And stocks are priced optimistically right now. The S&P 500 trades at 24 times earnings, roughly 50% above historical averages. So what should you consider instead? Dalio's research points to 3 categories that have historically navigated these periods well. First, businesses with pricing power. Not broad index funds, but carefully selected businesses that can raise prices faster than inflation and generate cash flow you can actually use. Think about companies like Procter & Gamble that can raise prices 25% when costs rise 20% while consumers continue buying because they need the products. Second, physical precious metals, gold and silver that you own and control. Not paper gold or mining stocks, but actual physical metal. Throughout history, when currencies face pressure, gold has tended to hold its value. It's a form of insurance against monetary uncertainty. Third, short-term treasury securities and cash. This is your flexibility. When uncertainty arrives, you want liquidity because that's often when the best opportunities emerge. The people who built fortunes in 2008 and 2020 weren't necessarily the smartest. They were often the most liquid. The fourth secret is this. Paper represents a promise. Physical assets represent facts. And when promises face pressure, which history shows they periodically do, facts tend to endure. Let's bring all 4 secrets together and understand why they matter now more than in recent memory. Secret 1. Never trust what you see. Most wealth signals around you are theater. The people who appear richest often have the most debt. Stop competing with performances and start building real substance. Secret 2. Never reveal your liquidity. Silence is your most powerful wealth preservation tool. Once people know you have resources, everything changes. Keep your numbers private and your moves invisible until they're complete. Secret 3. Never leverage on liabilities. Debt used to require assets that generate cash flow can build wealth. Debt used to acquire things that drain cash flow can destroy it. Buy half the house the bank approves, drive a reliable used car, save the difference, and direct it into productive assets. Secret 4. Never confuse paper for wealth. We're in a different environment than the past 40 years. Traditional portfolios may face challenges. Consider businesses with pricing power, physical gold, and cash as core holdings. These 4 secrets represent the difference between thriving and struggling over the next chapter of economic history. Look at what Dalio's research shows. Every major economy eventually reaches a point where debt levels become concerning. We're approaching that point now. Total U.S. debt exceeds $90 trillion. Federal government debt stands at $38 trillion. Interest payments exceed $1 trillion annually. When debt cycles reach their conclusion, 3 things tend to happen. Defaults, where obligations aren't met. Restructuring, where terms are renegotiated. Or inflation, where the currency is devalued. History shows one of these 3 outcomes always emerges. And in every case, the people with capital and strategic positioning thrive, while those without face significant challenges. Look at what happened in the 1970s. The people who had lived modestly and avoided these wealth traps accumulated assets when prices were depressed. By the 1990s, they built generational wealth while their neighbors were still working. The exact same pattern emerged in 2008. People who were over-leveraged lost homes and jobs and had to sell assets at the worst possible moment. The people who had lived conservatively and maintained capital bought foreclosed houses at 30 cents on the dollar and stocks when the market was down 50%. Within 5 years, their wealth had multiplied. The pattern doesn't change. Economic cycles operate like machines. They follow principles, and those principles don't care about feelings or excuses. It's not about your salary. History shows people earning $40,000 a year building serious wealth because they understood these principles, while people earning $200,000 a year struggled paycheck to paycheck because they refused to learn them. The window to prepare doesn't stay open indefinitely. We're in the later stages of this cycle. Over the next 12 to 18 months, positioning matters more than it has in years. The people who act with clarity will be prepared. The people who hesitate may face regret. If you take just one thing from this video, let it be this. Wealth isn't built by chasing what everyone else is chasing. It's built by understanding patterns that most people never see. It's built by making decisions that feel uncomfortable today but create security tomorrow. It's built by ignoring the noise and following principles that have worked for centuries. You now understand what few people ever discover. The question is what you'll do with this knowledge. If one of these 4 secrets resonated with you, share it. Drop a single number in the comments. 1, 2, 3, or 4. Let's see which principle hits hardest for our community. And if you haven't subscribed yet, subscribe now. This channel exists to reveal the patterns that shape financial outcomes, the patterns most people miss until it's too late. Your financial future isn't determined by luck. It's determined by the principles you follow and the decisions you make today. Now go apply what you've learned. Everything you need is already in your hands.